Welcome to Cincinnati's best ever real estate investor mastermind. We are here live last Tuesday of February 2026. We meet live in the Deer Park Community Center on the last Tuesday of every month for this local meetup. If you're in the area or you can make your way to Cincinnati, Ian has this week. Highly recommend that you come check this out. And thank you for checking out the Cincy REI show as well. My guest speaker is our co-host, Ian Cruz, who's come into town from San Jose, California. We've got a couple things going on this week, but one of them is this opportunity to speak to you all. We have a couple of things that we want to discuss. The first one is how to build partnerships for scale. How can you 5x, 10x the deals that you're able to do based on finding the partners whose strengths are your weaknesses and for whom your strengths are their weaknesses. So we're going to talk about that. We really want this to be Q&A driven. So we don't have 45 minutes of talking at you prepared. Please don't expect that. This is going to be a really short, lame podcast episode if you guys don't have questions. So we'd much rather give you the general idea and then let you decide what the specifics are that you are interested in. And then we want to get into a dive into Cincinnati market data. So this podcast, we want to make sure every single episode has one of a few different pieces of value that we're providing to people who are investing or want to invest in real estate in Cincinnati. They are neighborhood-specific expertise, general market knowledge about what's current, what is happening in greater Cincinnati right now, the things that impact real estate investing. When we talk strategies, we're talking specifically about how those strategies are working in Cincinnati. What parts of Cincinnati still work for a BRRRR deal? If you want to get a house hack, what are different parts of town going to do for you with regards to the financial outcomes? You're not going to learn how to house hack or learn how to BRRRR from this podcast. This is about taking those strategies, applying them to Cincinnati, what is working in 2026 here, and where in the market do you need to go to make those things work. And the last one is good stories. The horror stories that real estate investors for some reason love to share, the wins, and especially the stories that help the listeners better understand real estate investing in Cincinnati. So key details, how people have navigated working with the city, CMHA, other things that are more Cincinnati specific. So I want to go ahead and dive in here. Ian, why don't you go ahead and introduce yourself briefly?
Hi, everyone. Thank you again for taking the time to be here. And if I haven't met you at a previous meetup, would love to find the time after this to actually get to know you all. But yeah, I'm Ian, Slocomb's business partner. We co-founded TLP Investment Services together. Prior to doing that, I had been working on the consulting arrangement with TLP Property Management in a financial capacity. My career background, I got my CPA many years ago, worked 2 years of Big Four public accounting, and then worked 10 years at a venture capital firm as their manager of finance. On the side, have been traveling to and investing in Cincinnati, traveling to Cincinnati since 2004 because I'm a weird Bay Area born Cincinnati Bengals fan. But then started investing here and started working with Slocomb, met him here at this meetup, and one thing led to the next, and we've been partnering to create our investment firm.
So our partnership is relatively new. I want to dive into the questions that you all have for us, the things that you might be trying to figure out on your own, struggling with, that we can apply our story and our experience to directly. My background is the opposite of Ian's. I did go to college. I went to college for things that are not helpful for being gainfully employed. I was a professional full-time youth minister when I got into real estate. And through my experience in going full-time in real estate, focused on operations. So it works really well for the two of us, based on what you just heard about Ian, to let him be the finance and numbers guy. And I focus on making sure the horse drinks when I lead it to water. The horse being our real estate investments. So we've known each other for quite a few years. In 2024, we ended up haphazardly partnering together with another guy, Liam DeLumpa, great guy, on an 8-unit deal in Northside, 2 4 families next to each other. The value play was a commercial broker was selling an 8-unit deal as if it was a commercial property, but it was in fact 2 residential properties that were side by side and separately parceled. So really, it was a classic example of you profit when you buy, because we were looking at what the residential valuation of each of these properties would be individually, and there was a significant difference between that and what we had to pay for it as an 8-unit commercial deal from a commercial broker. So we exited that. It was around 18 months. The other value to us was it was an opportunity to try out our partnership. Ian, being in California, he had worked with other property managers, other operators in the space. It was his opportunity to figure me out. It was my opportunity to figure him out and the way that he was going to handle collaborating with investors, capital raising. And yeah, we had a successful exit. That was the 2024 deal. The 2025 deal was a 73 unit. Let's just 9X it in our next deal. And that's 6 apartment buildings, 5 of them on the same street in Northside, the other one in College Hill. We are in the throes of our value play currently. It's February 24th. Ian, if you want to get into the specifics, I'll let you, but our occupancy is a bit low. We've had a few tenants leave, but it's the highest revenue that the portfolio has seen in the almost year that we've owned it because of our ability to get our business plan executed and increase revenue. So this is not a major announcement, and quick disclosure, this is not a solicitation for investment, but we are under contract for a scatter site portfolio of over 100 units now. So not 9X 73, but about 1.6. And we expect to be able to take down a deal like that or larger every year, because between the two of us, we have all of the skills required to put these deals together, make sure that they're profitable, and then make sure that they get executed on, so that we actually realize the profits that we project. And we do bring on other partners sometimes to help with some of the things that we are already good at between the two of us when we don't have the bandwidth. But there's a fairly clear delineation between Slocomb is the operator and Ian has more of an acquisitions role for now, at least, and is more of the finance and investor relations. Let's start there. I just said a bunch. Does anyone have any questions? Feel free to introduce yourself if you want to. Not required.
I was just wondering how you guys finance these large deals that you guys are doing.
So the 8-unit, we used a local bank that is still a fan of construction financing. So we were able to get a construction second for mostly the CapEx things that we wanted to do, dealing with the clay, sewer lines, and some tuck pointing, a couple other things, the foundations. And then, Ian, you want to take the
73 unit?
Yeah.
So keeping this within the partnership lens, that's my role to be handling all the financing, equity as well, raising capital from investors, but also sourcing the financing. To keep this at a high level first and then get into the details, when you go into 5+ unit properties, you're using a commercial loan that are going to be financed based on the performance of the property instead of your individual DTI, things like that. There's going to be a lot of criteria. If you have more questions, I can get more into the weeds and the nitty-gritty. But as you get into bigger deals, you're looking at financing with a local bank like Community Trust Bank or all these different banks that you build relationships with, or you can go for an agency loan, agency being Fannie Mae or Freddie Mac. So our 73 unit, we finance with a Fannie Mae small balance loan. For everyone that's trying to get into the 100 unit space, that's like a rite of passage almost to get that first loan under your belt. They are more difficult. The insurance requirements are a lot more stringent. They vet anything and everything about you as a borrower, and they make it very painful. Slocomb can give you all the pain that we went through trying to get an agency loan in today's market, and especially in today's climate, they're looking to lend really on institutional quality assets that are newer, not the 70s small value add play that we were very specifically targeting. So there's a right time and place to go with a local bank and an agency lender. The agency loan on our deal is a non-recourse loan, so that's a benefit. It has lower interest rates. It has a 30-year amortization compared to 25 years that you would see with the local lenders. So there are benefits to it. They do make you escrow quite a bit for rehab and all that kind of stuff. But what I told some people as one of my takeaways is that I thought that the most responsible thing to do was to go with an agency loan, but the most responsible thing to do is just close on time. And sometimes there's more hoops to jump to be able to get that rate. But we use an agency loan for the 73 unit.
So the agency loan is what we have now. It's not what we acquired with. And that's what Ian was referencing when it comes to closing on time. We got to tell this story. So the agency process was dragging, and the property condition assessment that is required for agency debt, Fannie or Freddie small balance, was looking to require significant repairs to the properties before they would close the loan. The seller wasn't going to do it, and we didn't want to spend that money on the seller's property while they would still have an out to get out of the contract and just take our earnest money and the money that we had spent improving their property and go sell it to somebody else for more. So we were basically sent an ultimatum by the seller on March 25th. It was the night of this meetup. Last Tuesday of March last year, 2025, anybody wants to look it up, that I'm standing in front of you all or sitting in front of you all and presenting, and Ian's blowing up my phone. We were basically given an ultimatum, closed by the end of March or I'm pulling the deal from the seller. So we had to put together a list of who has $3 million that would want to lend it to us in the next 5 days on this deal. And to be fair, we ended up with 3 hard money loan offers. And I will say, credit to Grant Smith here with Sharper Capital. He was able to reel in one of those for us. We went with a different option because the other one had no origination fees. And since we only wanted to have this loan for the few months it would take to close the agency debt, we went with the higher interest, no origination fees, and saved significant amounts of money. But we had to scramble. And a part of that was because we were trying to acquire C-class 1960s and 70s properties with agency debt. And so we're talking about a lender who wants to see that there aren't any cracks in the asphalt parking lot, who's looking to lend on 1960s, under-operated, underappreciated by the current owner, apartment buildings. And man, they came up with some ridiculous stuff, like OSHA compliant handrails for the roof hatches that I've never seen required anywhere else. Off the recording, ask me about my opinion of the engineer who did the PCA report, and I'll share it. But so we ended up having to scramble, and thankfully, that's not really an operator move, but I've been doing this in Cincinnati for a dozen years, and I've made enough contacts through the years. There have been several times in my investing career when I had to pull out a Google Sheet or a Google Doc and start it with, who do I know who? And this time it was, who do I know who could lend us this money in the next 5 days? And we ended up getting it figured out. The excess in interest that we had to pay, we actually ate that out of our acquisition fee instead of leaving it to the entire partnership. So we just took a smaller acquisition fee by the amount of increased interest that was paid for those first 3 months, the 3 months that it took after that to get all of the condition requirements for the loan met. And the numbers still worked on the deal, even with that higher interest anyways.
I think that day I was on 54 phone calls or something ridiculous like that, calling, scrambling, trying to figure out what needed to be done and coordinating everything. But to put this back in the partnership lens, if you're investing in real estate, you're going to go through some shit. Stuff's going to happen. And through those kinds of experiences, you understand who you're partnered with. Your true colors are going to show. Us making the decision, it could have very easily been that one of us didn't agree with covering the private money interests out of our own pockets, but we both felt like it was the right thing to do to protect our investors. We both got to see each other in moments of stress and decided to create a business together afterwards. That was one of the things that Slocomb told me from the start. He was very hesitant to creating partnerships, but he said that he's more willing to partner on a property rather than a business because a property has a defined end date. So our 8-unit, our little 8-unit, that was an 18-month thing. If that didn't work out, we could move on into the next thing, forming TLP Investment Services. We're a little more intertwined in that sense. But we went through quite a bit from a consulting arrangement, from some big deals, a lot of wins, but a lot of moments of stress as well.
Other questions?
I was wondering, what kind of partnership structure do you guys have? How do you structure your partnership?
Yeah, I want to answer because there's quite a bit to partnerships. Are you thinking a partnership on buying a property?
Yeah, I was just referring to the specific deal that you were talking about. You guys just form a partnership for that specific deal, or you guys have a company together?
To also clarify to get the best answer, are you looking to syndicate deals or partner, raise money and separately as well?
Well, I'm not there yet, but yeah, I want to learn about it.
Okay. Because we could talk about the 50-50 partnership, or we could talk about partnership dynamics as a whole with co-GPs.
TLP Investment Services, between the two of us, is 50-50. And that is providing the acquisition services, the asset management services for the portfolio that we put together, that we acquire with investors. So that's each of us owning 50% of it. I've never had a partnership go that wasn't 50-50. This is not legal advice, but your attorney will tell you that 50-50 is really dicey because you can end up with things that cannot be decided unilaterally. The attorney always wants to see 51-49. They always want to see that someone has a majority. And every time that I've done that, the dynamic within the relationship didn't pan out long term. So I'm a big fan of 50-50, especially because of the dynamics within our partnership and what each of us brings to the table. It made a lot of sense. I'll let you get more into the weeds here, Ian, but from a broad strokes perspective, with each of these properties that we're looking to buy, we're looking to raise capital from other investors who we have raised capital from investors whose preference is to remain passive and have their liability limited. So we are structuring deals in such a way that those people who just want to place capital and get a return on it can get a really solid return with us. They leave us all the decision-making power, all of the liability, non-recourse debt, but all of the liability that there is on us because we're the professionals. We're the ones who know how to make this deal work and how to analyze it, make sure that we're buying the right things for the right price, and that we're getting all the work done that we need to for the right price. Ian, can you go a little more into that?
Yeah, to backtrack to the 50-50 partnership, or maybe let's say a small joint venture, one of the key things that gets spelt out in the operating agreement is you'll have your different levels of decisions and different thresholds of approvals that you'll need. What is a crucial decision? The sale of a property needs 100% approval for, whereas this type of decision just one person needs to sign off on. So all that kind of stuff gets spelled out in your operating agreement. But to talk about the process of acquiring, for example, Parker Woods Flats, we brought on other co-general partners into the deal. There are different roles that are structured within the general partnership. So acquisition is one, who puts the hard money is another, who's doing the ongoing asset management is another, who's doing the investor relations and raising the capital. That can be proportion to you raise $5 million and somebody raises $2.5 million, they get 50% of the points of whatever gets allocated there. Who's the key principal? These are 5 defined roles to being a GP within a deal. And then who found the deal, if I didn't say that one. And then probably the bigger roles there are the asset management, which are ongoing. Acquisitions obviously has some weight. And the investor relations and putting together the capital, those have a lot of weight. And then in the deal, that will be like a general partner or a Class A member. Then you'll have the Class B partner within the deal that puts in money into the deal. There will be a split or a waterfall that defines the returns. When you sell, the way that we structure the deal, when you sell the deal, 100% of capital gets returned to passive investors in proportion to how the money was invested into the deal. And then there's going to be some arrangement for the split afterwards. It could be 80-20, it could be 70-30 with a preferred return, meaning that investors get their money first, anywhere from 5 to 8%.
There are a lot of ways to slice that pie.
Yeah.
Most generally speaking, LPs are bringing all of the capital, and GPs are bringing the deal, making it happen, executing on it, and making sure that there's profit for everyone at the end of the day. And there is a lot of information about this available online. And frankly, bestevercre.com is one of the best places to look for it. Best Ever CRE is the platform that started this mastermind group, the networking meetup, which is why it's called Cincinnati's Best Ever REI Mastermind. So I highly recommend checking out bestevercre.com. There's the Best Ever CRE show, daily commercial real estate investing podcast, where you'll see a lot of episodes cover this kind of stuff and all the different ways that can be structured.
I've had experience in partnerships, and some of the things, and I think you alluded it to a little bit, how do you do the decision making when you've come to an impasse? Somebody just give in Is it based on in your operating agreement? Does that seem to generally solve all the issues?
Yeah, curious how many people were in the partnership. Were you at a
Two married couples, but they're
Okay.
like our best friends. And that's what keeps the partnership working is the relationship has been around for 30, 35 years. So we're trying to preserve that relationship, but sometimes on little tiny things that can blow up a little bit.
Speaking specifically to little tiny things, I tend to just let them go. I want to know what the impact is. This is not fair to your question, but I try to go into partnerships knowing that there are a variety of ways things could pan out or a variety of exit strategies that would still be beneficial to me. I don't need to squeeze all the juice out of the orange every single time. And I also don't need to squeeze an orange every single time. There are a variety of positive financial outcomes that are all going to be okay for me if they happen within an individual partnership. So you're not talking about raising capital for passive investors here. So that's kind of the default answer first is what's best for our investors. Outside of that, I would say with a lot of little things, I would either just let them go if there's not a major financial impact, or I would make sure that there's some sort of quid pro quo where I'm figuring out what are the little things that matter to my partners, what are the little things that matter more to me that can be reciprocated later. And the other thing that Ian was saying about partnerships is that I want to know they can end. I want to know that there's a defined exit strategy. So the real estate deals that we're partnering on currently all involve selling all of the real estate by a certain deadline. So that way our investors know there's a deadline by which they get all their money back plus gains. And also it means that if our partnership doesn't work out, as some of my other partnerships have not, we know that there's an end date and we can just focus on making money now and then not having to do this again.
And then to also chime in, if you had more partners, you may have different thresholds for a critical decision. You need 100% agreement for people to sell, maybe 70% for a significant decision to change property management or things like that. But because you said minor things, that may be somewhat of a personality thing and expectation thing if you get to the point where you have two partners and they're arguing over which landscaper to use for immaterial dollar amount, right? Maybe there was an expectation, a difference from the start with who was making that decision, because ultimately some of those decisions need to just be one person, right? Yeah.
I will say snow removal in January was not an immaterial amount.
Yeah.
That was really frustrating when some of our vendors wanted to charge us, especially when I've got rehabbers who want to make 50% more money to just go clear driveways and sidewalks. But snow removal, man, I'm going to avoid saying things that can get me in trouble since this is going to get published on a podcast. But yeah, snow removal was a significant expense for a lot of properties back in January. Other questions?
When did you spot the opportunity that I would benefit from having a partner in my business, and how did you spot those weaknesses or opportunities to improve by having a partner? And then subsequently, what was that due diligence process and search process like for finding someone who would be a good fit for those things?
I spend more time than most trying to figure out what my own weaknesses are, if that makes sense. One thing that I am not, it turns out, is a hunter. I don't get the thrill of finding the next deal the way that a lot of real estate investors do. Ian does, especially when we're not in the throes of something else. Ian is much better at making sure he's pinging all the relevant brokers, getting in front of all the deals that they'll share with us. The one we have under contract right now was effectively brought up to us off market because we've had success in the past closing on difficult deals with this broker. But Ian is the one who got us in front of this opportunity. Also, I'm pretty smart and good at math, but not as good as Ian is. And I haven't made a career out of being good at math the way that he has. It made sense, especially when we got to the 73 unit deal. I will speak a little bit on Ian's behalf before I hand over the airspace to him. But I was looking for someone who could understand the ins and outs of how the deal is structured, make sure that everyone was making money. I wanted to be able to understand the underwriting, but I didn't want to have to do it from scratch the way that he did. And he lives in those spreadsheets much more than I do. My focus is on making sure we're able to execute and making sure that the things in the spreadsheet can actually happen. Some of that is checking expectations and making sure that where we think market rents are, how long it's going to take to do things, based on my experience, making sure those numbers are not accurate, like going to happen in the future, but are much more probable. And in order to get into these larger deals, I'll say Ian was looking for someone he could partner with who knew that he wasn't going to stop until the deal worked, and figure out the leasing, figure out the maintenance issues, figure out how to keep CapEx costs down while delivering quality results, increasing length of tenancy, all of those things. Those were the kinds of things that Ian needed from me. But go ahead.
Yeah, so first of all, I know that you and DJ have partnerships of your own and partnership dynamics, so happy to trade stories. But to take this a different angle and maybe a more unique angle is that I'm from California, so obviously different skill sets can help with underwriting and the financial backgrounds, and also in terms of raising capital, bringing in entirely different group and base of investors to the deal. So both of us during Christmas break were all hands on deck putting together our deck and getting ready for a presentation and getting in front of people. He flew to San Jose to speak to our base over there. So there are some dynamics there. I think there's a skill benefit. I think that kind of California, Ohio aspect is a little bit unique. I think it took more of my initiative to come here, meet him, and then see that we drived and worked together on a few projects for this to happen. Do you want to talk more about that?
Ian is really well tapped into a lot of real estate investor communities in California, especially in the Bay Area. I think as Cincinnati-based real estate investors, we may
and they looked at this.
misjudge
They didn't
or
find
underestimate
any
the number of non-local investors
identical
who
cracking
think that
anywhere
buying a
else. Where like
duplex
if
is
the
only
building
way
is
to invest in
separating,
real
it cracks
estate
in two places.
non-locally, to
And you
invest
can
from
also
California
see
and the Midwest.
evidence.
And when you only have
Feel
two
free to stay in the
units,
shade. You'll
and those
see in a
two
moment.
units
You'll see there's a little
are
extra concrete
red
around the
eye
corner in
flight
the back,
away from you,
where it appears
more things will go wrong in a
that
larger
this
portfolio,
settling
but you have
had
it
been
spread
addressed
across more
decades
revenue
ago.
streams.
And so
you can have
what
really
our
poor
report from the
financial
structural
performance from a
engineer
duplex because there were
recommended
unforeseen
was
circumstances that a
seal it all,
73-unit
make it
portfolio
watertight,
can smooth over because
check it
if you
any
have down
year,
units
check
for
it
a few
every
months,
year.
you have
If
70
you
other units
identify
that can
movement,
generate revenue and
have
make
us
sure
come
it's still
back.
cash flowing.
This epoxy seal
There
over
are
time
a lot
will
of
age,
investors out
dry,
there who
crack, and it may
have
open without the
bought their own
building
property
settling at all.
in Cincinnati, from
So
elsewhere,
we'll just
also
we'll
from
just redo the
Cincinnati,
epoxy.
bought a
There was a
duplex,
time
a single family, a
2
4
owners
family, man,
ago
we have so many brick bunker
when
fourplexes just
the roof
all
had
over
been so
Greater
deteriorated
Cincinnati.
that water was
They buy
getting
one,
inside
and
the walls.
costs are higher than they expected.
And
they didn't understand
the
the business
theory
plan.
as to why it
and they don't
opened
end
up
up making
here
any money.
is that there
but they
was
still
enough
want to invest in
water
real estate.
that had
A lot of
gotten
those
into the
people
wall
would
in
be
the winter it froze
happier and get better
expanded
returns
and created
as
that
passive
crack.
investors.
So not structural,
to some degree, we've
not
tapped into
settling,
that as well.
not
Mostly
the building,
Ian,
not half of the building sliding
understanding
down
there
the
are
hill.
a lot of people who
just
want to be invested
water
in real
intrusion
estate,
from a
but
bad
definitely don't have the
roof getting in
expertise.
and expanding.
Also,
in the
don't have the
winter.
time to figure it out on their
So
own.
that's why being
a lot of
watertight
those
is still
people
critically
are better
important, even though it's
served
not
by
a
investing
structural issue.
passively.
You'll see.
This is really for Ian. You obviously had a great look
Yeah,
at
you'll see some
venture
evidence.
capital, totally
When
different
we go back to the
asset
front door,
class.
you'll see some evidence
What
of
drew
like stair step
you
cracking and things
to look
like that.
into commercial real
It's all
estate
up by the
and
roof line,
make that full-time
and the
pivot
structural
into
engineer's
that asset
opinion
class?
is that it is
To
most
step back,
likely
I
all
mentioned
from
I
when it
worked
was, had
10
a bad
years
roof
at a
and
venture
water was
capital
getting in.
firm. I was their manager of
and
finance,
creating that
preparing their
separation.
financial reporting,
But it's the
handling
kind
their
of
cap
thing
calls,
with
distributions, things
1960s
like
brick
that.
buildings
That's
that
on
you're gonna
a
find
bigger
all over
scale, right?
Cincinnati,
Raising
especially where
$250
there's a
million
hill. And
funds
these are the
or
kinds of
things
things
that we
you need to
don't
take very
necessarily have
seriously
access to.
because
And real
you'll
estate,
see
it's more
decades
tangible,
ago,
and there's
someone
something that I
spent
could get into
several, if not tens of
earlier
thousands of
with
dollars
a
taking care
lower
of
dollar
what was a
amount and
structural issue
see
at
in
the
touch
time.
and started
It's a
like
big
many of
thing to
you
hit
by
your
house
CapEx
hacking
if you're not
locally where I
planning
was
for it.
at. And
makes
it
sense.
just made sense
And
for
this
me
is all
to
stuff that we
branch
had
off
figured
and
out
get into real estate and kind
well
of apply the
before we
same
closed
thing
the
because
deal, well before it
syndication,
was
when you start
funded,
doing this, it
that
is
we
the
weren't gonna
same
have to,
vehicle,
spend
and
a
all
whole
the
bunch
things
of
that
money.
I learned previously, they apply. Putting
and
together
the
those
ceiling
waterfalls
was
to
done
avoid
by
that kind of stuff. There was more
members of my
activity
team.
in a real estate
people,
transaction than investing in
people on
startups.
my team.
With a
So
startup,
we
you
paid
just invest in it,
direct-
then there's a Series A up round or down round, and you just kind of write up the value, and then eventually you sell, and there's capital gain. But Real estate stuff has a lot more to it, which keeps it interesting, but it was both familiar, but also a little more accessible and more my thing, right? When I was investing in startups or when I was working at the VC, I was on the investment calls on a lot of life science companies, and probably interesting to you, probably interesting to a lot of people, but a lot of this stuff went over my head, honestly. So I've really enjoyed everything about real estate and just making the pivot.
When you were looking at partnership and partnering with someone, what made you realize that Slocomb would complement your skills and also complement your personalities? Were you looking for somebody who had a different personality or a similar personality, or just somebody who could be cool under pressure?
I'm going to say something and then answer you. So I have had a number of partnerships in the past. So I've experienced a lot of things similar to Slocomb. You want to be selective with who you partner with. I've partnered with people who later moved in different directions, which isn't a bad thing. It's not every partnership has a nasty breakup. It's just one partner had a kid and decided to focus on flips in the Bay Area and just moved on. I had partnerships through the platform Fractional, which is a startup that kind of facilitates these partnerships, and had partnerships with a lot of people, so learned how to make decisions that way. And then with Slocomb, I think we had worked together enough and seen not just in terms of our personalities that things would work, but also our personalities, philosophies, but even our skill sets. And I think I reference this every time, but it's going to be mentioned anytime you're looking at an investment firm. When we're putting together our org chart and all the different roles and responsibilities, an easy way to categorize this is by your 4 roles, which are the hammer, the hunter, the money, and the brain, right? So the brain's the underwriter, the money is the person bringing the capital or raising the capital, the hunter is the person finding the deal, and the hammer is the person who's managing the asset, right? So in the commercial real estate world, asset manager, acquisitions person, investor relations, they're always those different roles, and knowing where your strengths are and what you need, because no one person is going to be all 4 of them. Who's going to fit what box for you to partner in, and it's good if between the 2 of us, it's not like I'm just 2 and he's just 2. We are probably 3 each, so we can cross over with the skill set as well, but just a natural complementary fit. Time for the Queen City Pulse, a quick look at what's making news in Cincinnati real estate. Let's start with new supply. Hills Properties opened the first units at Relay 129, a 402-unit Costco-anchored community in Liberty Township. 24 units are occupied and 75 more are pre-leased ahead of the July 2026 full delivery. It's Hill's largest Cincinnati project ever. Bigger pipeline story over in Clifton Heights. University of Cincinnati topped out the tallest tower at a $330 million Block 1 and Block 2 expansion. Turner Construction is delivering 1,310 beds across 4 buildings, opening fall 2027. It's UC's first housing-based campus expansion in decades. Staying in Uptown, an existing UC-linked deal is on the market. 101 East Corey, 116 units and 272 beds in Coreyville, 1 block from campus, is listed by Franklin Street with offers due May 6th. He holds a master lease through the 2027 and 2028 academic year, with rent upside if the university doesn't renew. Shifting downtown, 3CDC is asking City Council to lease Piat Park as part of a $128 million plan to remake the North Central Business District. The scope, 120 residential units, 153 hotel rooms, 22,000 square feet of retail, and a $62 million Garfield Tower redevelopment. Next. Over to Pleasant Ridge. The Pleasant Ridge Development Corp. closed on a $2 million TIF-funded land purchase at Montgomery Road and Ridge Avenue. The plan calls for a 124-unit mid-rise with 5,000 square feet of retail. It's the first in a sequence of high-density projects for that business district. Up to Hamilton, a Butler County jury awarded Spooky Nook Sports $3.3 million against Steve Kuhn, a former co-owner of the Warehouse Hotel at the Champion Mill redevelopment. The jury found Kuhn fraudulently concealed his financial ties to PCS and Build, the construction manager that walked off the project in 2022. We covered Spooky Nook in Hamilton on episode 4 with Grant Smith and episode 6 with UHN. That's a Queen City Pulse. Back to the show.
I'd like to transition the conversation here. So We just started a web scrape and rental market dashboard for the purposes of having our own proprietary data about what's happening in the rental market in Greater Cincinnati. On the rental side, our web scrape has only been live for a few days. But I have some questions for you guys to see how close you all will get. Just some interesting facts about what's going on in the real estate market in Cincinnati. We might do this by a show of hands, even though people on the podcast won't be able to see them. By show of hands, how many of you think that there are more for rent listings in Greater Cincinnati right now? And how many of you think that there are more for sale listings than for rent? So think about that for a minute. Are there more homes for sale or homes for rent in Greater Cincinnati right now? How many of you think it's homes for rent? How many of you think it's homes for sale? As of this morning, there were 1,264 active rental listings in the zip codes that we're tracking as the Greater Cincinnati market. Total active for sale listings, 1,734. So a lot more for sale than for rent. A couple other things here that stood out to me, and I will say we're looking at a very limited data set, so I'm looking at average days on market, but I'm really only looking at things that are active today. I'm not looking at things that have pended recently. So if you just look at all active listings right now, does anyone want to guess what the average days on market is for a rental listing in Greater Cincinnati? As of this morning, if you went on Zillow and found every single active rental listing, what would the average days on market be? We got 57.8. Interestingly enough, and I would have expected this to be more skewed, if you're just looking at apartments, it's 59.2. Single family rentals, 54. I would have thought there was a larger delta, that single family rentals were leasing more faster than apartments. But it turns out everything is slow right now. And everything is slow nationwide, but it was interesting to put some numbers to this. I'm guessing that when we get to the point that we're doing month-over-month data and we can look at things that have come off the market in the past month, that days on market will come down. If you look at the homes actively listed for sale right now, the average days on market is 85.8. So 4 weeks longer than rental listings. And this isn't included in the data that I have here, but just in the last 4 days, of the 1,734 active for sale listings, in the last 4 days, over 300 of them had price reductions, which is nuts, if you ask me, given how short of a time frame that is. Average rent across rental listings, $17.18 a month. Median rent, $14.95. That's across everything. If you look specifically at apartments, average rent is $15.16, median is $1,300, all on the nose. And then for single families, the average is $22.79 and the median is $2,095, based on our web scrape this morning. So just some interesting stats to put out there. We'll be talking about next month how much has changed since today.
Yeah, but to step back, those numbers are very high. For days on market for properties for sale, if you're looking at residential properties to buy, or even if you have properties and you're wondering why they're not leasing in a certain amount of time. I don't have the data for 2 years ago, but I'm sure it would be a lot less.
So inventory was a lot lower, for sure. If you're having trouble getting things rented, then you're not alone. I wish I had our average days on market at TLP offhand. I don't. We just switched leasing platforms. So all of our data started fresh 4 weeks ago. And so we only have 4 weeks of data inside Rent Engine. So that's not really relevant because we ported over closer to 2 dozen listings and started with fresh days on market. So I don't really have a good number right now. But yeah, a lot of things are taking a long time. Any other questions?
What do you think that's due? Why do you think it's unusual this year?
I think that the sentiment around lack of affordability is more heavily weighted than the actual economic performance of the city or the country. People just feel like things are less affordable. If you go back to August of 2024, that is when the current market really hit this kind of slump that a lot of Cincinnati is in currently. It's end of February, it's the winter, things take longer. But August of 2024 is when we saw the rental market fall off a cliff. July, you could ask any rent you wanted and get it. Not literally, but figuratively. And then September, everything was sitting, price reductions, became super competitive, became a renter's market. And then coming out of that winter, 24 into 25, we saw A class outperform C class. And that has been the case since then. That the K-shaped economy that people keep talking about, if you have a premium location or a premium property or both, you are still seeing rent increases. You're still seeing your average days on market going down, whereas your 1960s 1 and 2 bedrooms that haven't really changed much in the last 50, 60 years have been flat to declining depending on where you are since August of 24.
You're from San Jose, but you are looking for deals in Cincinnati is where you actually find your deals. Is that because of the big price disparity, obviously?
It's actually because of Carson Palmer. And now, like Jamar Chase and Joe Burrow, that's really what is bringing me into Cincinnati.
Yeah, definitely partially. I think it's a perk to be able to fly here and after working a hard week, finish the week watching the Bengals lately get killed. I watched the Vikings game with Ton over at Mountain Tower. It was rough. So I started investing locally in the Bay Area. You're not going to scale too much there. Obviously, there is appreciation. It is capital intensive. We had some apartments there. We just sold a 6-unit that we're 1031ing over here right now. But I like the numbers here. As he mentioned, I used to fly here for reasons outside of real estate, but in going here, you're always looking at properties, you're always pulling up Zillow and looking at deals. And as you've seen in the last few years, if you were investing in a Dallas or in Arizona, there was a lot more construction. So there's a lot of population growth. There is going to be appreciation there over the long term, but there was a lot more of a boom and bust in those markets when interest rates went up, whereas we could map it out a lot more. We are forcing the appreciation on our properties. In a lot of the underwriting, we don't need to assume anything. The underwriting of our last deal, we're selling in 5 years at the prices that we're seeing stuff listed for today, as long as we acquire at the right basis, which just makes a lot of sense. And considering that's the biggest thing. If properties are cash flowing and you can buy with positive leverage, so positive leverage is when the cap rate or the returns on your property are higher than the cost of your debt, which you're never going to find in the Bay Area, buying 3 and 4 cap properties. Right? But if you're buying something unlevered, meaning without a loan, would return 7% on your purchase price and you're borrowing at 6%, you can do that deal all day. So that's why I've loved investing here. Numbers guy, CPA, the numbers work, so just decided to go all in investing here.
Did you look at other markets too?
Not much, honestly. I think that is the funny story of little things in Cincinnati and maybe knowing people outside of being in a real estate lens and knowing that I could build a team here. Because if I was doing deals in some small town in the middle of nowhere, maybe it's exciting when investing is new and you're flying out there. But now that I have a 10-month-old daughter and another one on the way, it's if I'm going to come out here, like, want to be somewhere that I want to be in the room with you all rather than somewhere that's not sustainable for the long run.
He even came outside of football season this time.
I know your data is too young to establish a trend, but can you extrapolate or postulate anything? If there's more inventory coming to market, is that going to improve the rental or hurt the rental? Is it investors selling out their rentals and increasing the inventory? Is it people selling their houses and moving into the rental market? Do you have any thoughts?
On the sales side, the market remains healthy. Buyers are less interested than they were a couple of years ago. And so you see people pulling their house or their real estate off the market when they can't get the number that they want or need. And that's a sign that things are still healthy, but it's definitely swung more in the favor of buyers. So most of the data I've seen about that in particular recently has been national. The concessions buyers are able to get are greater than they've been in a decade. Concessions off of purchase price. And that is playing out here. One of the things that we have, though, that a lot of markets don't, is that we still have a lot of starter home neighborhoods where it still does make sense to own instead of rent, because you've got purchase prices in the high ones, low to mid twos, depending on where you want to be. You're not going to find that in a lot of other markets across the country. On the rental side, we are seeing higher absorption now, so more things coming off the market than going on. That may just be seasonality for the moment, and we may see it pump again in April, May. But the data that we have for February is that more rental listings are deactivating than activating.
You mentioned 58 days average on the market right now?
Yeah.
How do you or TLP compare to the market? And then what are you seeing, or what's advice to combat a renter's market today in the leasing world?
I was saying earlier, I wish I had the TLP data. We switched from running our leasing through Appfolio to running it through Rent Engine about 4 weeks ago. So our quote unquote days on market got reset for everything when we hit Rent Engine. So next month I'll have a much better number for you. We're certainly lower than 2 months on market. I get antsy at 2 weeks. My personal belief is that you can't go 2 weeks without having enough data from the listing to know how well it's performing and how well it's going to go based on its current pricing condition. So we're much lower than that, but I wish I had an actual number for you. One of the things that we track is net move-ins. I want to know that we have more people moving in than moving out. And in the last 12 months, we've had 9 more move-ins than move-outs. I don't have an average days on market for you specifically. What was the other part of your question?
Just more like, what are you doing, or what are you
Advice.
seeing in the market on the leasing side to combat a renter's world?
So a couple of things, especially 2/3 of TLP's management portfolio is third party. So we like to have options available for those landlords. It really is the Class A stuff that's just flying off the shelf at market rents. When you get into B and C class, there's more competition. We have done a combination of things. One of them is just drop the rent to where it will rent. My preference is what we call a 3-month promo. So we will have a significantly reduced rent for the first 3 months. The basic math is if you reduce the rent by 1/3, so you go from $1,800 to $1,200 for the first 3 months. If you can rent the apartment a whole month faster because you did that, you break even. Because you're just realizing some of that revenue earlier, but at the end of the day, you're going to have collected the same amount of rent, and you've offered someone significant incentive to come rent from you instead of somebody else. So we like the 3-month promo a lot. That's really been our go-to in a lot of these kinds of circumstances. That's been really helpful for us. It does jack up the number of inquiries we receive from unqualified prospects. And we explain up front, you still have to qualify based on the entire rent, not just the promo rent. But it certainly increases the volume of work my team has to do for those listings, but it also gets them rented a lot faster.
Curious, but what are you seeing and doing?
Yeah. Feel free to introduce yourself, too,
Yeah,
so that people
I'm DJ.
understand you're actually an authority
Yeah.
on this.
I'm DJ. I also do some apartments. We're seeing similar. It's fastest to the bottom. But I would say, depending on where you're at, you could be in Norwood, you could be in Batavia, you could be where you're at. Every market and pocket resonates a little bit different. So there isn't one
For sure.
thing that I can use that works every time. But the biggest piece is speed. So I make sure that we try to make a change really quick, make a decision. We try to say within a week. I know that's probably a little premature, but I believe that 3 or 4 days on Zillow, and you can see how many inquiries come in if you are going up or down as far as volume. So really focus on speed. We've tried everything from half month's rent, $300 off, free application, 2 months off. You name it, we've tried it. We haven't found one that sticks, but we do try to deter away from reducing rent if we know that we're already competitive in that market. But what has been consistent is making sure that you have really quality, high-end listings. And that's probably the biggest differentiator beyond any concession that you can provide. How does my unit look on Zillow compared to everyone else? Do I have a virtual tour that I can provide really quick and provide a better experience on the front end? Because if I can move faster than everyone else, I'll most likely be able to convert and get that filled quicker.
Speed to lead is critically important too.
Yeah.
One of the reasons for us to move to Rent Engine was their AI leasing agent. I'm not really willing to call it an agent yet, and there are a lot of kinks and quirks that need to be worked out, but I don't have a human on my team who can be in communication with 20 prospects at a time 24/7. So the speed to lead using AI for that first piece of the conversation has been really helpful for us. We saw our inquiries increase by 50% moving to Rent Engine because of some of the things that they do to better promote rental listings on Zillow. But really just how quickly can you get in front of these people? A lot of things downstream from that for us as well are based on speed.
Our inquiries when we made the change, just with that speed to lead, went from roughly 10 to 15% conversion rate to about 53% this past week. So
Yeah. Wow.
just the speed to lead made a big difference. Now,
It's
they're
huge.
not all qualified, but top of funnel helps build the bottom of the funnel.
Yep, for sure. That's really insightful. DJ, thank you. I think it is time for us to conclude. We have been at this for an hour now. I really appreciate you guys for being here. Again, I said this before we started the recording, but the most valuable asset that any of us have is our time. So thank you all for taking the time to be here with us instead of the other people you could have spent it with, to hopefully learn something, gain some value from the presentation, the conversation, the networking that we'll continue to do as we wrap up. We will be here last Tuesday of March. If you haven't yet joined the Facebook group for Cincinnati's best ever REI Mastermind, I highly recommend that you go find it. Not only because of announcements about meetups, things like that, but also because of the quality of the advice that the quality of investors in this group give to everyone who asks questions. So appreciate you all. Thank you. And we'll see you all next month.